All right, everyone. Good to see you. Lots of friendly faces here tonight. I'll be talking about the new CMHC rules and guidelines that have recently come out. So, government likes to throw us curveballs all the time. Lots of things to unpack here. So let's get into it. So CMHC was recently informed, and I should clarify, by the way, the government came out and said, by the way, we're making all these changes. CMHC had no idea this was coming out until the government had told them and told everybody else, and it was all announced just last week. So interesting that, or 2 weeks ago, I should say. So it's interesting that this is the way that CMHC we had been informed, or CMHC had been informed. I remember when the news first broke out, we actually reached out to our CMHC rep, and she said, Kyle, we're just trying to figure this out, just like you are. So, classic government. I won't get into, too much of a political rant here, but it seems like it's a way of buying votes, or at least trying to solve the homeowner or home housing crisis in Canada, one step at a time. And it seems like perhaps finally, after 15 years of tightening, maybe we're finally getting into a period where mortgage rules may actually be loosening just a little bit. So we'll see what comes down the pipe. Anyways, there's a couple of things that just recently changed. So the first change is that they're allowing a 30-year amortization for insured mortgages again. It's been quite some time since they've allowed 30-year amortizations. And this actually was a recent rule that came out back in August. However, it was for both first-time buyer and buying brand new. And now it's either a first-time buyer or buying brand new real estate. So you do not need to be a first-time buyer to get a 30-year amortization if you're buying brand new. You also can be a first-time buyer getting a 30-year amortization, so it doesn't have to be brand new, you just have to be first time. One thing to keep in mind is that the insurance premium is slightly higher. To put things in perspective, if you're putting 5% down, the CMHC insurance premium is 4%. If you're doing a 30-year amortization, it'd be 4.2%. So it's a 0.2% increase to the insurance premium. Not a lot, but a little bit of an additional cost to get a 30-year amortization. Also, this is the big one too, especially for people in Vancouver and Toronto and other major urban centers in Canada. They've increased the maximum purchase price for insured mortgages from 1 million to 1.5 million. This is a big deal. This is actually something that had been on the docket to discuss back in late 2019, early 2020. And then when COVID hit, it got completely tabled and nothing changed. In fact, the original number was supposed to be about 1.25 million that they were looking at, maybe increasing it up to. So it was a bit surprising, actually, they went all the way up to 1.5 million with this big change. And the down payment amount is still the same calculation that we use today, which is 5% down in the first 500,000 and then 10% on the remainder. And that means that you can effectively buy a $1.5 million property with only $125,000 down, which is a big deal. And there's no additional CMHC fees to go above the $1 million range. It's just the same CMHC premium that you'd be paying, regardless, even if you bought under $1 million. And then the third thing that also changed, which is kind of interesting, is they also removed the stress test on renewals. And so if you have a mortgage coming up for renewal and it's an insured or uninsured mortgage, then there's no stress test applicable. So you don't have to qualify the rate plus 2%. You can just qualify the actual rate that you're getting at that time. And the reason that they're doing this is they're trying to open up the playing field a little bit. So if you're renewing with your own bank, your own lender, you don't have to requalify. And so the thought was, well, that's not really great for consumers, because what if you don't qualify to move the mortgage? You have to take whatever the current bank is willing to give you. And so they're trying to increase and improve the consumer's perspective a little bit here by adding more competition on your renewal. And there were, I have some commentary about this a little bit that I'll go into a little bit later, but great news on the stress test coming off of renewals, at least, which is really, really good. So I do want to dive into a couple of the more minor details on this. So this is the first time that the limit has been increased since 2012. So it's been 12 years since we've seen significant changes to the CMHC insured cap or limit. Also, an important date to keep in mind is that these are effective December 15th, and that's the date that we can submit the deal to a lender and the lender can approve it. Does not mean that the completion date can be December 15th or shortly after that. It has to be the submission date. So that's an important key that you need to keep in mind. And this is replacing the rules that came out in August, which mean that you had to be a first-time buyer and buying brand new. And now they've changed that and removed that. So now you can be either a first-time buyer or buying brand new in order to get the 30-year amortization. And this is an important point to make, which is that on average, about 30 to 40,000 mortgages per year are insured. And so this is going to affect a lot of people. And in fact, we might even see that perhaps the number of insured mortgages increases because now the million to 1.5 million is able to be insured. So we're going to see that more people can now qualify to purchase real estate between the 1 to 1.5 million range. So what does this all mean for you? You know, let's talk and deep dive a little bit into the 1.5 million max price. One thing that's unique about this, and not a lot of people are aware of this, but as a broker, there's a lot of different options for what's called stated income. So if you're self-employed and trying to qualify for a mortgage, there aren't a lot of great options for you when you're self-employed and you're buying something that's over $1 million. So currently, if you're buying under $1 million, there are actually really good insured programs where we can do what's called stated income. So instead of saying this is how much money I make, how much money do I qualify for in a mortgage, we reverse that and say, well, what do you want to qualify for? How much income do you need to state in order to qualify for the mortgage? And then we reverse engineer that number and try to provide bank statements, financial statements, et cetera, to be able to provide some verification and proof that that is a reasonable amount of income. So it's a very different process. And as of now, we've been in a position where if you buy over $1 million, oops, you don't really qualify. There's not really great options to put minimum down payment down. And a lot of those customers end up having to go to what's called B lending. So higher interest rates, higher fees, et cetera. So this is one of those scenarios where if you're self-employed and we're wanting to look between the $1 to $1.5 million range, now there will be more options available to you. And we're quite excited about this because I literally have a few clients that were looking at right around that $1 million range, and now all of a sudden they can go up to 1.5 million and qualify underneath this program and get very competitive rates. Which brings me to my next point. An insured mortgage is actually getting the best interest rates, and so now we're going to be able to see that buyers purchasing between 1 and 1.5 million now maybe be able to qualify for better interest rates by going insured. So this means that in general, insured mortgages usually are about 0.5% lower on the interest rate than an uninsured mortgage. And this could represent about $38,000 in interest savings over a 5-year term on a mortgage. So it's a pretty substantial amount of savings that you could see on the insurance by getting the mortgage insured. And obviously the most important point is the down payment factor itself. So before, you would have to put 20% down on any purchase price over $1 million. Now it's 20% down on any purchase price over 1.5. Well, that means if you go all the way up to 1.5 million, you can put as little as $125,000 down instead of $300,000 down. That's a massive difference. So we're going to find, especially in those urban centers where it's really difficult to buy anything underneath $1 million, we're going to see that this is going to open up the playing field quite a bit for borrowers who want to buy something between 1 and 1.5 million with the minimum down payment. I've already talked to a number of clients and potentially new clients that are now wanting to reach out and redo their the whole game plan. Instead of waiting for a few years or having to wait until maybe they can get a gift from family or whatever, now they're able to take action fairly quickly. So I thought this slide was kind of interesting, where it's talking about the Canadian cities where more than half the homes for sale cost $1 million. Look at Delta. 80% of the homes are over $1 million. Vancouver 70%. Oakville in Ontario, Richmond Hill in Ontario, Richmond in BC. Obviously you can see this littered with BC and Ontario towns. But this is going to affect a lot of towns, primarily in Ontario and British Columbia. So will make a really big difference and an impact on those two markets specifically. And I think what we might also see is that more people might say, well, you know what, if I can go a little bit higher than $1 million now in the purchase price, maybe I can find something that has a basement suite in it. So obviously in Vancouver, Greater Vancouver, is a bit tough to get into the 1.5 million range, but maybe this is something where going just a tiny bit under 1.5 million, finding something that has a basement suite in it may actually be better for the cash flow and may help you get into a home. So very interested to see how this all plays out and how many more people are able to purchase properties in the 1 to 1.5 million range. The 30-year amortization. So a couple of stats for you. This is increasing borrowing power by about 7%. So those that can do 30-year am, so either first-time buyer or buying brand new, it improves the borrowing power by about 7%. It'll decrease the payments by about 9%. So the payments will go down a fairly significant amount. And this is an interesting one that doesn't get a lot of press, but it is relevant for some of our clients that are looking at buying investment properties. So we could, for quite some time, actually get insurance on anything that's 2 to 4 units. It's just that we often didn't even look at this as an option, because for the longest time, you could only get a 25-year amortization, and you still needed to put 20% down minimum. So a lot of our clients even get a slightly better rate, even if it's 2 to 4 units. Now, most people would still prefer to do 30-year amortization to keep the payments lower. So this is interesting now. If you're buying a brand new property that is between 2 to 4 units, and you can get a 30-year amortization on it, buying it as a rental, we might find that some clients are now going to be interested in getting insurance on this property, because now they can get a lower interest rate. And depending on the down payment, etc., you might find that there are better qualifications available, which is sometimes true for insured programs. And then secondly, which is probably more relevant, is getting a better interest rate. Especially if you're putting a larger down payment, like 35% down, the insurance premium is not that expensive. And so you probably will find that if you're planning on putting a larger down payment down anyways, and now you can get a 30-year amortization, then you might be more inclined to look at getting that mortgage insured. So kind of an interesting corner case situation where you might see that more clients are interested in going insured now if it's 2 to 4 units. And by the way, the insurers usually want that to be legal 2 to 4 units. So an illegal basement suite or something like that usually wouldn't count. On the stress fee renewal, so not having to stress test a mortgage increases the borrowing power by about 12.7%. So pretty big increase here. And I did see some stats, and this is really hard to break down, hard to get some really accurate numbers on this, but some of the estimations that I was looking at is that about 10% of people that came up for renewal wanted to switch to another lender, but couldn't re-qualify, and so they didn't. So they had to renew with their existing lender. And the result of this is that, in general, on a renewal, your savings could be anywhere from 0.05% to maybe 0.25%, like on average. It's somewhere in that range most of the time. And so for many borrowers that couldn't qualify before and now can qualify to switch their mortgage, could be finding that now they could save anywhere between $500 and $2,500 per year on a $500,000 mortgage, which on a 5-year term could be $2,500 to $12,500 over a 5-year period of time. So, this could stand to save borrowers a lot of money now that they have more options. So if you were somebody who was worrying about qualifying for your renewal, just note that if you re-signed up with your current lender, you never had to re-qualify, or generally don't have to re-qualify in those scenarios. But if you wanted to move it to another lender, then you did. So effectively what the government has done here is they've increased competition, which is generally a good thing for consumers. If there's more competition, lenders will have to be more competitive on their interest rates on the renewal, which should hopefully get you a better rate, whether it's renewing your current lender or moving it and switching it to a new lender. So that's really the most important information regarding these new rules and changes. I get asked about interest rates every day, and so I always want to include a quick update and snippet about what the latest and greatest is on interest rates, the current predictions, and where rates are heading, just so everybody has a kind of an idea of that, and some updates to what we've been looking at as well. So on the rates front, earlier in September, the Bank of Canada dropped rates for the 3rd consecutive meeting, so it's down 0.75% from the peak now. And one of the things that we're looking at here is if you have a fixed rate, there's no change to the Bank of Canada moving. If you're already in a fixed rate, nothing is going to change. Fixed rates may drop moving forward, but if you're already in a fixed rate, then there's effectively no change. If you are in an ARM, so an adjustable rate mortgage, for every $100,000 that you're borrowing, your payments would have decreased by about $15 per month per $100,000. And so depends on the type of mortgage that you have. But if you're in a variable and it's an ARM, then you'll see that your payments will actually decrease. And typically it's the first of the month or the next payment the next month that is usually going to show and represent this difference. And if you have a VERM, a variable rate mortgage, then that means that your payments are static and more of your payment now is going towards the principal and less is going towards the interest. So interestingly, what I found is that in 2022 and 2023, when rates are going up, a lot of clients wanted the VERM. They wanted the product where the payments were going to stay the same, so that then as the prime rate increased, people weren't worried about their payments also increasing. Now that we're in a different environment, now where the rates are starting to decrease, more and more clients are opting for what's called the ARM. So this is where the interest rates going down will actually mean that the payments will also decrease at the same time. There's a quick question from Mark here. What income does someone need in order to buy a $1.5 million home with 125 grand down? And how does that compare to the average family income for BC and Ontario? So just to give you an idea here, generally speaking, you can multiply your income by about 4.5 times, and that's the maximum amount that you would qualify for on a mortgage. So if you had a $200,000 household income, for instance, and multiply that by about 4.5, you're getting up to about a $900,000 mortgage or so. So if you were trying to max yourself out and getting into a $1.5 million purchase price with a minimum down payment, you'd probably need an income of closer to about $275,000 roughly household income. So it's really going to be for those that are have two professionals making six-figure incomes in general. I was just working on some clients' numbers just the other day, and I think household income was just a little bit shy of 270, 265, something like that, and they were able to go up to the 1.5 number. So yeah, that's something to take a look at. Also, if there's rental income, then that can also help with the qualifications as well. So something to consider. Yeah, when you look at the average income, of course, this is going to be mostly benefiting those that have higher incomes. If you are putting 20% down, by the way, instead of less, lenders do allow for higher debt servicing qualifications, and so you may find that you might be able to qualify for about 5 times your income if you're putting 20% down, just because the lenders will go to higher debt servicing. So use a higher percentage of your income towards all of your debts. So in that case, you'd probably be able to qualify for a little bit more if you're putting 20% down. So one of the reasons that we're seeing interest rates decrease, of course, is the inflation. Inflation is slowly getting under control. And just so everybody has an idea here, the target for the Bank of Canada, and in general, most major economies around the world, is usually around 2%. So you can see that we're getting closer and closer, very, very close to that number. Interestingly, if you were to strip out the inflation that is caused from housing, and so increases to rents, in housing, or increases to mortgage payments, then we're a lot closer to 1 or even less than 1%. So this is where the Bank of Canada is now starting to go into an environment where they're starting to decrease interest rates. Now there is one small caveat to that, and we can see that with oil prices, for instance, oil prices all of a sudden are going through a little bit of a rebound right now. And oil is in so many things; it is a large expense. And so when we're tracking where inflation is heading, one of the things we look at a lot is oil prices. We're starting to see a little bit of an upward trend, and most of that is because the unsettling geopolitical situation out in the Middle East. So if there is going to be another war or more military activity, then in general oil prices do go up, especially if there's a lot of flexing that happens with OPEC, et cetera, out in the Middle East. So we have to watch that mindfully, because that is one thing that will affect inflation. And maybe the Bank of Canada doesn't decrease rates quite as quickly as is being predicted if the oil prices and just in general inflation goes up. So the question of will rates go up or go down, getting the crystal ball out is definitely telling us that rates are going down. This is a chart. So there's two different things here. The orange line at the top is what the is basically showing the projected a prime rate for the next little while. So this was done right before the Bank of Canada announced their recent cut to cut the prime rate down to 6.45. But you can see that the expectation is the prime rate will be down about 1.25 by the end of the year. In fact, I think that chart now is showing the prime rate will actually be 4.95 in about 12 months time. So everything's kind of shifted down by about 0.25%. You can see there's pretty aggressive cuts coming or predicted to come in the next 12 months for the prime rate, which would show then if you're taking a variable, you'd see a pretty big decrease to your interest rate and therefore your interest cost. Now, the one on the bottom here is basically the bond market. And this is a good proxy for where fixed rates are heading. So don't look at the actual rate itself, because the lenders are always going to look at that cost of funds, they call it, and then usually add about anywhere from 1.5 to 1.8% on top of that to determine their fixed rate pricing. You can see then that the interest rate right now is 3.23 and projected to be down to about 2.73 in 12 months, which is telling us that then the expectation is that fixed rates will go down about 0.5% over the next 12 months. Now, I find it interesting that the chart shows that it bottoms out in 12 months, stays about there for another 12 months, and then actually starts to slowly tick up. So in year 3, it's up by about 0.13%, and then goes up another 0.15%, and then another 0.17%. So it's actually showing that fixed rates will bottom out in about 12 to 24 months. And the variable rates will actually continue to inch down a little bit further heading into the 3rd year. So what this is showing us and telling us is that the variable is going to see the biggest drop. Now, right now, variable rates are higher than fixed rates, which does make sense because right now a variable rate is about 1% higher than a fixed rate. But it is showing that that based off of this information, if what comes to fruition or what is projected comes to fruition, then a variable should actually outperform a fixed. For a couple of different reasons. So looking at that chart, fixed, flat to decreasing, at least decreasing in the long term for sure. Like as of right now, the bond market is kind of settled and there's not a ton of movement downwards right now in the fixed rate market. But although we're obviously going to likely see, longer term or even medium term that the fixed rates will start to decrease. And then the prime rate decreasing by about, again, probably about 0.75 to 1% by January. So looking at even looking at the next meeting on October 23rd, there's about a 40% chance of a 0.5% cut from the Bank of Canada on that meeting. So it's been fluctuating anywhere from 40 to 60%, but give or take about a 50% chance the Bank of Canada doesn't go down by a quarter, but goes down by half, which is a pretty big cut. Just a quick question here. Can a self-employed individual incorporated get a mortgage without insurance? And yes, you can. There are some programs that are available even without the insurance. It's just that the insured program is often a really good way of getting the mortgage. And there's a bit more leniency with how they evaluate the income. But if you're self-employed, you can definitely get a mortgage. Generally, the lenders just want to use a 2-year average of your income in order to help you qualify. And that's the challenge usually with self-employed borrowers is when you're incorporated, you're trying to keep most of your income in your corp so you pay less tax, so you don't pay yourself as much. But there are programs available like corporate net income where they take some of the corporate income and add it to your personal income to then boost the personal income to help you qualify. And that is similar to how stated income works. So there are programs available for it, but they're just not quite as flexible as the insured programs. So just something to keep in mind is that it is a bit easier going through the insured programs. So one of the questions we're getting often asked is, should we be in a variable rate? And so we were comparing, and this is kind of what we're finding that a standard interest rate would be. And occasionally we can see lower than this, by the way, but kind of a standard interest rate across the board. About 3-year fixed 4.49 and variable about prime minus 0.7. So that works out to be 5.75%. And so we've been looking at this analysis. I just did this just the other day for somebody looking at a $720,000 mortgage that would complete in December. And the savings was projected to be about almost 10 grand over the 3-year period of time. And so the pendulum has swung considerably towards variable. And I would say probably 80% of my clients in the last 2 months have been going variable. Not everybody. There's a lot of reasons to still consider a fixed rate term, but a variable rate is starting to project to be showing at least a lot less in interest. So if we compare the pros and cons of going variable, the variable is projected to be less in interest over the term in pretty much every case. One of the important points is that some of our clients say, yeah, I don't like to be in a variable rate. I prefer fixed. You can lock into a fixed rate at any time by going with variable. So just keep that in mind. If you go variable, you can always lock it into a fixed rate at any time during the course of the mortgage. And so the question often is, do you want it, if you want a fixed rate, that's fine. Do you want a fixed rate today, or do you want it in 6 or 12 months where maybe the rates are down about 0.5%? And so a lot of clients think, oh yeah, actually, I guess I'd rather just ride it out for a little while and then lock it in at 6 or 12 months. Another benefit to the variable is that the penalties are only 3 months interest instead of an IRD or interest rate differential penalty, which can be a lot more expensive, and that's the penalty that could apply to a fixed rate mortgage. On the con side, you know, you're probably saving money in years 2 and 3, which is great, but what about year 1? And so a lot of clients, because interest rates have been elevated and finances are a lot tighter than they used to, a lot of clients are a bit more concerned with, well, what about year 1? That's what they're kind of focusing on. They want to have a lower payment in year 1, less in interest in year 1, which undoubtedly, if you take a 3-year fixed versus a variable, you're highly likely to save money in the first year. It's just that years 2 and 3, you probably make up and make more up in those years than what you paid in the first year. So something to consider. Also, it's harder to qualify for a variable because the rate starts at a higher rate and the stress test is even higher than that. So it is harder to qualify for variable. And in some cases, clients that want to go variable actually cannot because they don't qualify for it. So that's something that you also want to keep in mind too. One other thing I wanted to talk about is we've over time have actually been converting a software program called Atlas. We've actually converted this to software recently, and so it became and started off as a spreadsheet. We eventually had converted it and made it into a software, but we're able to run an analysis and basically very quickly by entering in some information and details into our system, we can run the numbers simultaneously for all of the lenders in the space here to see which lender has the best interest rate and which one you qualify with and which ones you don't. So something that we're working on, and we are also rolling it out to mortgage brokers ourselves now. But it's software that we're able to utilize and can give customers a very quick idea of how much they qualify for without having to collect all the information. So if you do want to look at understanding how I don't want to go through the full application, I just want to have an idea of what I qualify for. You can book a consult with myself or one of my team members, and we can give you some feedback on what your options are fairly quickly. Also, many of you already know that I'm a best-selling author, and so if you do want to get a copy of my book, Rockstar Real Estate Investing, just send us a note. You can email us and then let us know your mailing address, and then we'll be happy to put a copy of the book in the mail as well. I do have a couple of questions in the Q&A, so I'll make sure they answer that. And any questions, please put that in the Q&A, and then we'll be happy to give you some feedback. Okay, so Mark is asking, next year I'm considering switching my income to a holdco for tax purposes. Can my holdco buy my personal residence? So yes, your holdco can buy a personal residence. That being said, it often doesn't make the most sense to do that, mostly because of the capital gains exemption. So if you sell your personal residence, there's a large capital gains exemption that you get. Whereas if the holding company buys the property and then in the future, if it sells it, then it has to pay capital gains on that. So what I do find is that on occasion, if you've got a ton of cash in the holdco that you want to use for purchasing a property, and then sometimes it does make sense to buy and underneath the holding company name, just because you don't have to pay taxes to get the money out of the company and into your personal name to then buy it as a personal property. But in many cases, what I recommend usually is just to use personal cash, buy the residence in the personal name, and then use the holdco cash to then invest and buy rental properties or something like that with it instead. But Mark, we can definitely give you some more feedback on that if you wanted me to take a look at things with more in depth, like looking at your specific situation. I've got another question. So I'm new to this. So can I please request you to explain the difference between ARM and VERM? Yeah, so they're both variable mortgages, but an ARM is an adjustable rate mortgage. And so that as the prime rate moves up and down, the payments move up and down with it. A VERM is also a variable rate mortgage, but it's a static payment. So the payments do not change. The amount going towards the principal and interest is what changes when the rate goes up and down. So anybody in a VERM, which is pretty much every major bank except for Scotiabank, will see that as the prime rate drops, the payments will remain the same. Whereas with Scotiabank, as an example, they're an ARM. So a lot of people felt the pain on the way up with Scotia because rates kept going up and the payments kept going up. But now it's going to come back down again. And people with Scotiabank will see that now their payments will start to decrease. A lot of what we call non-bank lenders accessible through mortgage brokers also are an ARM, an adjustable rate mortgage. So that means that you will get payment relief as the interest rates decrease over time. Awesome. Any other questions, guys and gals? Yeah, this one was a quick one. It was more of an update on the CMHC rules and guidelines and everything. Very interesting. I'm interested to see what happens to the marketplace with these changes, and if it makes a big difference in buying power, and just the price range of 1 to 1.5 million might actually see a bit of a kick up in December, when a lot more buyers are able to purchase properties in that price range. So we'll see. Who knows? We don't really know until the date actually rolls around. But it looks like, we've got one more question here. So can the VERM product change interest rates? So the interest rate is always changing with the VERM, but it's the amount that goes towards the principal and interest that's that is really changing. So the payment stays the same, but the amount going towards interest and principal is what changes as the interest rate decreases. And so if you wanted to get payment relief on a variable rate mortgage, you can lock it into a fixed rate term, which is a lower rate, to then get a lower payment. But typically, if you're in a variable rate mortgage, then your payment is set and it will remain at that level, even as the prime rate moves up and down. Awesome. I don't see any other questions here. So feel free, of course, if any other questions come up, please reach out. We'd be happy to help you and answer anything that comes up. And of course, as more information comes out with regards to this, we'll make sure that you're informed. So I'll, oh, is there one in the chat here? Oh yeah, there's a couple questions in the chat. So 1 second. Okay, so is there typically a trigger rate on the way down so that the payment reduces on my variable rate mortgage? So no, there's no trigger rate on the way down. So variable rate mortgages do have a trigger rate on the way up, but there's no automatic trigger. So as the interest rate goes down, you don't automatically have a reset button where the rate or the payment resets and lowers. So that doesn't come up, unfortunately. And then there's also another question here. So how does the 60%, 40% program with provincial government work? I'm not sure I'm understanding the question here with the 60%, 40% program. Maybe just give me some clarity on that, Vicki. And then Adele is just mentioning setting the Atlas form, making sure received. Yeah, I'll double check that. Maybe just send me a note, and then we can take it from there, Adele. Thank you. David Ebby announced the 60-40 program. What exactly was the 60-40 program, though? So the government is offering 40% of a down payment as a loan to the buyer. Oh, okay. Yeah, I missed that. I've had my head down all day today on working on transactions. So I'm actually surprised I missed the 60-40. So I don't have actually any details on that. I'll put out some more information about that as soon as we can get some clarity. Yeah. Oh, the low income. Oh, okay. Yeah, I think that's something slightly different. Yeah, so I'll investigate that and get some more details on it and circle back. I'll put out some information out to our customer base about that. Let's see here. Okay, I think that's it. So thanks so much, everyone. It's good to see you, and looking forward to staying in touch. Thanks a lot, everyone.